Welcome to the Reverse Mortgage Seminar. Top 10 reasons seniors choose a reverse mortgage loan. Trends show that middle to upper class seniors are now taking advantage of their home equity as means for further investments. A leading provider of home equity solutions for retirement, or HECMs, recently revealed the top 10 reasons seniors are choosing a HECM mortgage loan. They surveyed over 50,000 recent HECM applicants as to why they were taking a reverse mortgage on their primary residence. The number one reason? To make home modifications or repairs. Number two, to buy an investment property or vacation home. 3, to help children purchase a property. 4, to provide children with an early inheritance. 5, to create college funds for grandchildren. 6, to establish a trust fund. 7, to cover in-home care costs. 8, to have more financial liquidity. 9, to maintain their current lifestyle. And 10, to pay off other debts. Our learning objectives. Section 1, the myths and misconception. Section 2, the basics. Section 3, program features. Section 4, loan process. Section 5, scenarios and uses. Section 6, summary. Section 1, the myths and misconceptions. Misconceptions. Some misconceptions about reverse mortgages include: reverse mortgages are for desperate seniors or for the house rich but cash poor. The home must be debt-free before you can qualify. When the reverse mortgage comes due, the bank sells your home. The bank owns your home when you take out a reverse mortgage, and your heirs could incur the debt when you're gone. Older adult concerns. The grim legacy for many boomers after long working lives spent caring for families, putting children through college, and perhaps caring for their own parents will be to struggle financially in retirement as they live long lives, exhaust their limited financial resources, and find that their only income in later years is a Social Security benefit that may largely be used up by expenses for health care. Recent studies of baby boomers conducted by the Insured Retirement Institute have found health care costs will consume 23% of income. Approximately 35 million lack any retirement savings. More than 7 in 10 boomers plan to downsize and subsist on Social Security alone if they run out of money in retirement, and about half would try to return to the workforce. 30% of boomers have stopped contributing to retirement accounts, and 30% have found it more difficult to pay their mortgage. The importance of home equity. New academic research demonstrates how HECMs can play a vital role in retirement planning, not just as a tool of last resort, but as a strategic way to provide greater financial flexibility to seniors with ample savings. Section 2, the basics. Home equity conversion mortgage. The home equity conversion mortgage, or HECM, is a loan that gives borrowers access to a portion of their home value, requires no payments until the last borrower permanently leaves the home or another maturity event, like moving into an assisted care facility, selling the property, or the last surviving spouse has died. Note that the borrower must pay property charges, including property taxes, fees, and hazard insurance. The loan is non-recourse, which means that the lender can use only the property for lien satisfaction, and it allows for borrowers to retain title at all times. Reasons to consider a HECM: eliminate a monthly mortgage payment, supplement income, pay for medical expenses or in-home care, finance the purchase of a new home, pay off debt, and enjoy life's passions with financial ease. HECM eligibility requirements. All borrowers must be age 62 years or older, live in the subject property as their primary residence, demonstrate financial capacity and credit responsibility, attend an FHA-approved consumer counseling session, and obtain a HECM counseling certificate. Eligible properties. Eligible properties include single-family homes, FHA-approved condominiums, townhomes or planned unit developments, 2 to 4 unit properties that are owner-occupied, manufactured homes that meet HUD guidelines. HECM product options. FHA insured products. Fixed rate, monthly adjustable, annual adjustable. Proprietary program. A jumbo program that is a fixed rate only product with a maximum loan amount of $4 million. Principal limits. The initial principal limit, or PL, is defined as the maximum amount available to a HECM borrower at the time of closing. The PL is calculated using tables provided by HUD. These include the age of the youngest borrower, or eligible non-borrowing spouse, the lesser of the home's current appraised market value, or the FHA lending limit, which is $765,600, and the expected interest rate on the LIBOR 10-year swap plus lender margin. 2020 reverse mortgage limits example. If the age of the borrower is 70 years old, in 2018, the loan limit would have been $350,019. In 2019, $374,160, and the new limit in 2020 is $394,285. The overall increase is $44,266. 2020 reverse mortgage principal limit factors. As an example, if the age of the borrower is 70 years old, the maximum loan-to-value is 51.5%. If the value of the home is $500,000, the max loan limit would be $257,500. Appraisal. The HECM is a non-recourse loan, which means that the home is the only collateral used for repayment. Therefore, it is important that an accurate determination of the property value and property condition is obtained. The Federal Housing Administration, or FHA, requires that all homes submitted for insuring be safe, sound, and secure, which means they require an appraisal inspection and report completed by an FHA-approved appraiser. The appraised home value is one of the factors used in determining the loan proceeds available, or principal limit. Please note, principal limit calculations are based on the lower of the appraised value, or maximum claim limit of $765,600, or the purchase price. Effective for all case numbers assigned on or after October 1, 2018, FHA requires that a collateral assessment be performed on all HECM loans prior to closing. Based on the outcome of the assessment, FHA may require a second appraisal be obtained prior to approving the loan. Please note, the lower of the two appraised values must be used. Section 3. Program Features. Program Features. For adjustable rate loans, a line of credit grows over time based on current interest rate. 10-year provides equal monthly payments during the life of the loan. Term provides payments for a specific amount and time period. Upfront draw, an immediate lump sum withdrawal at closing, or any combination of the above options. For fixed-rate loans, an upfront draw, an immediate lump sum withdrawal at closing. HECM feature, line of credit. An unused line of credit grows at the same rate as the interest and FHA mortgage insurance premium which is charged on any outstanding loan balance. The line of credit cannot be frozen due to a change in home value, has no term limits or balloon payments, has funds that can be accessed, paid back if desired, and then accessed again at a future date. A line of credit versus HELOC. In the traditional HELOC and the HECM, you retain ownership, but only with the HECM there is no monthly mortgage payment required. Only on the HECM, unused amount grows over time, more available funds. Only on the HECM, it can never be called or recast, and only on the HECM is it a non-recourse loan. You can never owe more than your house is worth at the time of repayment. But on the traditional HELOC, there is a risk of foreclosure if monthly mortgage payments are not made. HECM feature: 10-year payments. The 10-year payment plan allows you to use some or all available funds for equal monthly payments for the life of the HECM. Change the payment plan at any time with a fee to the servicer. Note, under the plan, monthly payments are paid as long as the borrower lives in the home and abides by the terms of the loan, including maintaining the property and paying taxes and insurance. HECM feature: term payments. The term payment plan includes a specific dollar amount from available HECM proceeds to be received for a specific period of time. Monthly checks that stop at the end of the predetermined period of time. However, the loan does not become due and payable until a maturity event occurs. HECM for purchase. With a HECM for purchase, borrowers have the opportunity to right-size their home, relocate to a more suitable neighborhood, or move closer to family. Requirements. A HECM for purchase requires a borrower contribution based on a percentage of the purchase price and the borrower's age. The balance of the funds for the purchase come from the HECM loan. The property must be the borrower's primary residence and meet FHA property guidelines. As with any mortgage, the borrower owns the house, and his or her name is on the title. Additionally, monthly mortgage payments are not required. Payment is deferred until a maturity event occurs. Borrowers spend less money out of pocket and preserve more of their savings instead of spending it on their home. Borrowers can get more home for their money. A HECM for purchase could help them comfortably afford upgrades or a more expensive home. HECM for purchase example. A 62-year-old borrower would like to purchase a $400,000 home. Using a HECM for purchase, the borrower provides only $233,200 of his or her own funds for an equity contribution. The HECM for purchase finances the balance of the purchase price. The chart below illustrates various borrower equity contributions with varying ages and purchase prices. An example assumes an expected rate of 4.35%, an upfront MIP of 2% of the purchase price, and third-party closing costs of around $4,000. Consumer protections. Mandatory FHA counseling sessions are required for borrowers, non-borrowing spouses, and powers of attorney. This screens for competency and comprehension of the loan program. Financial assessment determines if the borrower has the financial capacity to pay taxes and insurance and ongoing maintenance of the property. Non-borrowing spouse rules make it possible for a qualified non-borrowing spouse to remain in the home even if the borrower dies. A non-borrowing spouse is one who is not going to be on the loan because they do not meet the HUD criteria to be a HECM borrower. A non-recourse property protection for borrowers and heirs ensures the loan payoff is secured by the property. Borrowers and heirs can never owe more than the house is worth when the loan is repaid. No prepayment penalty provision means the borrower can pay down the loan at any time or deferred payment. Insurance and safeguards. FHA insured product. The original statute of the National Housing Act of 1987 required a guarantee to borrowers that they would be protected by the General Insurance Fund. That insurance is now referred to as the Mutual Mortgage Insurance Fund. The insurance is generally funded within the closing costs of the HECM loan as an upfront fee. It is also a percentage of the annual outstanding balance. The costs. Finance closing costs include upfront mortgage insurance premium, which is 2% of the max claim amount, an origination fee depending on the loan product, and traditional third-party closing costs. Section 4. Loan process. Education, counseling, application, closing. We encourage you to include your family members and trusted advisors in your decision-making process. Section 5. Scenarios and uses. Mr. and Mrs. Jones love their home and their neighborhood. They have no intentions of ever moving. They have a home equity loan that is due, and they're struggling to make ends meet. They may need to make a hard choice and move out of the home they love. A solution using a HECM. The borrowers are age 70. Home value is $400,000. They currently have a HELOC on their house of $100,000. Their available HECM proceeds is $200,000. The available balance after the housing obligation payment is $88,000. The illustration assumes 4.35% expected interest rate with $12,000 finance closing costs. The borrower benefits. No monthly mortgage payments required. Peace of mind. They can enjoy living in their existing home, and they have increased monthly cash flow. Example, new home purchase. The scenario. Mr. and Mrs. Smith realize their home where they raise their children no longer meets their current needs. They want to move somewhere closer to family. Solution using a HECM. They're age 65. Their existing home value is $300,000. They don't have a mortgage. The new desired home is a $450,000 purchase price. Available HECM proceeds, $198,150. The equity contribution from the borrower's funds is $251,850. The liquidity increase is $48,150. The borrower benefits. They right-sized their home living. A new home with no monthly mortgage payments. They relocated closer to family. Increased liquidity. Example, aging concerns. Paying for home health. Aging parents are experiencing health problems. Adult children are concerned about how parents will afford the cost of care. Solution using HECM. The borrowers are age 80. Their home value is $300,000. They don't have a mortgage. The available HECM proceeds is $154,500. This can be used as a tenure, term, or line of credit. The borrower benefits. HECM proceeds provide needed home health care funds. Peace of mind. Decrease burden on the family. Retain independence from family, paying for health care. Remain in home rather than going in a nursing home. Section 6. Summary. Your HECM, your way. This powerful financial option can be an important part of a retirement funding strategy. HECM uses are as unique as the individual adult homeowner it is specifically designed for. The use of a HECM can afford the opportunity to enhance the quality of life for the adult homeowner, because quality of life should not decrease with age. Associations, and watchdogs. Department of Housing and Urban Development or HUD, Federal Housing Administration or FHA, Ginnie Mae, the National Reverse Mortgage Lenders Association, and the Consumer Financial Protection Bureau. Purchase HECM. Jack and Jill Purchase. Jack's age is 63. Jill's age is 63. The sales price is $581,717. The required down payment is $292,021. Their remaining equity is $289,695. The maximum loan to value, 50.2%. A comparable mortgage payment would have been $1,383.05 at 4% on a 30-year fixed rate. The end result is no mortgage payment. Increasing equity line based on growing value in the home, which can be accessed at any time on an adjustable rate HECM. 4.5% automatic increase in value on an annual basis through the course of the loan on the adjustable rate HECM, and the ability to refinance and pull out equity on both the adjustable and the fixed rate HECM. Refinance HECM. The borrowers are Jack and Jill Refinance. Jack's age is 78. Jill's age is 83. The appraised value of their home is $615,000. They had a mortgage payoff of $84,909. They wanted cash at closing of $96,652. And they wanted a line of credit of $130,626. They still had remaining equity of $288,435. Their pre-existing mortgage payment was $506.69 per month. On a comparable mortgage payment, it would have been $1,490.43 at 4% on a 30-year fixed-rate loan. The end result? No mortgage payment. The borrowers were able to get $96,652 cash out, a $130,626 additional funds available without any consequences. They could use that money to pay off debts, buy a second home, make updates to their existing home, or for any other purposes. Cash Infusion Refinance HECM. The borrowers are Jack and Jill HECM application. Jack's age, 64. He's the younger of the two. Jill's age, 65. Their appraised value of their home is $700,000. They currently have a mortgage payoff of $290,000. The cash required at closing is $86,000 from the borrowers. Line of credit at closing is $0. The remaining equity in the home is $386,000. Their pre-existing mortgage payment is $1,435. The end result is no mortgage payment. The borrower was not made aware of a reverse mortgage or HECM by his lender, as his lender was not HUD certified to do HECMs. Borrower could have put down the additional funds of $88,000, but his lender advised him to only put down 20% as he qualified at that loan amount. Motivating factor for the borrower is that there are health issues involved, and he wants his spouse not to have a mortgage payment should there be a maturity event. This is without even considering the increase in equity on a brand new home in his 55-plus community. Our estimate is between 8 and 10% per year over the next 5 to 7 years, which is called the growth period. Thank you for coming to our HECM presentation. Call us at 520-829-5219 for a personal consultation in your home. Enjoy your evening. This has been presented by Douglas and Melanie Sedam of ReverseMortgage62az.com. Coming soon, summer of 2019, a full-service real estate brokerage serving the 55-plus communities of Arizona. sbranchrealty.com, a full listing in all pertinent multiple listing services. Professional photography inside and outside of home and aerial photographs. Listed in over 50-plus real estate social media sites such as Redfin, Zillow, Realtor.com, Trulia, and many more. Open houses from 12 noon till 4 p.m. the first weekend the home is listed. Promotional flyers on the for sale sign. Professional representation and due diligence on all offers submitted. Discounted to 1.5% from the standard 2.5% commission paid listing agents. An example, the savings on a $650,000 sale would be $6,500 additional net proceeds to the seller with a higher level of customer service.